Imagine spending like 40% of your workday just trapped in dense corporate PDFs, pulling out tiny data points just to write a routine credit summary.
Oh, it's brutal.
It is a massive bottleneck.
Yeah.
And, well, that manual grind is exactly what Oracle wants to eliminate with their newly unveiled corporate banking agentic AI platform. They were actually calling it the death of the credit memo.
So welcome to your custom deep dive, where today we are unpacking how this multi-agent system actually works.
Yeah, and it is really crucial to establish right away for you listening that we aren't talking about plugging your financials into a general-purpose AI like the ones used to draft emails.
Right.
These are highly specialized agents, built directly on top of the Oracle Core banking and credit facility stacks. They are purpose-built strictly for trade finance and corporate lending.
Okay, well, let's unpack this. If an AI is the one actually drafting the official financial reports, doesn't the human credit officer just become like a glorified rubber stamp? That is the natural fear, right? But the role definitely evolves from author to approver. The oversight is really baked into the architecture itself. I mean, Oracle uses 3 interacting agents to handle this.
Oh, so it splits up the work.
Yeah, exactly.
Huh.
First, you have the extraction agent. This one uses advanced optical character recognition and named entity recognition. It pulls specific loan covenants and financial ratios out of those unstructured documents directly into the core system.
Got it. And then what happens next?
Then the synthesis agent takes over. It is constantly monitoring real-time market data from places like Reuters and Bloomberg, basically looking for early warning signals.
Oh, wow, which solves a massive latency issue, right? Because a human analyst might read a Reuters report on a Tuesday. But if the synthesis agent is plugged directly into the feed, it acts like a financial immune system.
Exactly.
It instantly flags a covenant breach the second a stock dips.
It totally does. It catches what humans miss in that lag time. And then finally, you have the narrative agent, which actually drafts the credit memorandum in a standardized format.
Okay, citing those specific data points, I imagine.
Yes, exactly. So the human's job is really to validate that logic rather than typing the whole thing out from scratch.
Right. But relying on an LLM to draft an official corporate memo, that introduces some major compliance hurdles.
Yeah.
I definitely have to push back on the contextual nuance here.
Oh, for sure. It's complicated.
Because corporate structures are notoriously messy. You have got non-standardized cross-holding structures, shell companies, off-balance sheet entities. If the AI hallucinates or, misunderstands that nuance, the bank could make a catastrophic lending error.
What is fascinating here is that Oracle actually recognizes that black box risk. That is why the AI cannot just issue a mysterious decree that a borrower is high risk. It really has to show its work.
How does it do that in practice, though?
Because the narrative agent pulls directly from the core system's data, it embeds direct hyperlinks back to the exact paragraph in the original PDF where it found that specific financial ratio.
Wait, really? It creates its own verifiable footnotes for the credit committee?
Yeah, basically.
Okay, well, that makes the oversight practical. But to actually build those footnotes and update the core system autonomously, the bank's underlying tech infrastructure has to be incredibly mature, right?
Oh, yeah, that is the real hurdle.
Yeah.
I mean, for these agents to function, a bank's legacy corporate core must have a write-enabled API layer.
Which is rare because historically, banks only allowed read-only access to prevent third-party software from breaking things.
Exactly. Now, the agent needs to safely commit complex financial data back to the central ledger without corrupting the existing data integrity.
Which means banks cannot just buy this software. They have to fundamentally modernize their legacy plumbing. Overcoming that infrastructure headache has to offer a massive return on investment.
It does. If we connect this to the bigger picture, it translates directly to operational velocity. It specifically reduces the time to cash in corporate loans.
Right, because in a high-rate environment, the bank that can process and approve complex credit the fastest gains a huge competitive edge.
Exactly. But this speed forces a major operational shift. They're moving away from traditional human-logged audit trails to entirely new LLM reasoning traces.
Meaning the AI has to literally log its step-by-step mathematical logic for every single number it generates right in the system.
Right. It is an entirely new framework for AI governance. The tech is ready to accelerate capital, but the legacy banking infrastructure and compliance models, well, they have to catch up to safely support it.
So basically, to pull this off, banks need modernized APIs and totally transparent reasoning logs. It really makes you wonder about the long-term trajectory here, especially since We're already seeing trade finance shift toward agent-to-agent communication just to resolve document discrepancies.
Oh, absolutely. It's already happening.
So I want to leave you with this final thought to explore on your own. As these systems get smarter and more autonomous, how long until the entire global corporate credit ecosystem operates without a single human ever reading a financial statement? I mean, how long until the agents are just shaking hands with each other?